It's January 28, 2026. If you checked your portfolio this morning, you might have noticed a tremor. Not a massive earthquake yet, but the kind of vibration that tells you something big is coming. For the last year, we've been talking about the Trump trade. We've been talking about deregulation, about tax cuts, about the American economic machine roaring back to life. But yesterday, President Donald Trump reminded the world and your wallet that there is a dark side to his economic doctrine. In a single post on Truth Social, the president didn't just threaten an enemy. He didn't go after China. He didn't go after Iran. He pointed a loaded economic gun at one of America's closest, most loyal military allies, South Korea. Here is the reality: Trump is threatening to hike tariffs on South Korean imports from the agreed-upon 15% to a crushing 25%. We're talking about autos, lumber, pharmaceuticals, the lifeblood of the trade relationship between Seoul and Washington. Why? Because, according to the White House, South Korea failed to close the deal. Now, before you click away thinking, I don't own Korean stocks, why do I care? Listen to me closely. This isn't just about Hyundai or Samsung. This is about the price of the car in your driveway. It's about the stability of the US dollar. And it is about a new era of global volatility where no one is safe from the trade war crossfire. If Hyundai cracks, the auto sector shakes. If the Korean won collapses, the currency markets go haywire. And if you think the S&P 500 is immune to a trade war with the world's 10th largest economy, you are betting against history. Today, we are peeling back the layers of this diplomatic crisis. We're going to look at the broken promise of $350 billion, the legislative gridlock in Seoul that caused this, and most importantly, I'm going to tell you exactly how to position your cash before the February deadline hits. Welcome to the financial war zone. Let's get into it. Let's look at the raw data. What actually happened? On Monday, President Trump took to social media and dropped the hammer. He explicitly stated that South Korea's legislature is not living up to its deal. Context is king here. Last year, the US and South Korea shook hands on a massive trade framework. The US agreed to lower tariffs, and in exchange, South Korea promised massive, sweeping investments into the United States economy. We're talking about factories, infrastructure, and high-tech jobs on American soil. But here we are in 2026, and Trump says the check hasn't cleared. The specific threat is a tariff hike to 25% on autos, lumber, and pharma. Now, currently, under the existing agreement, the levy sits at 15%. That 10% jump might not sound like much to a layperson, but in the world of global supply chains, where margins are razor-thin, a 10% hike is an extinction-level event for profitability. The market reaction was immediate and violent. Hyundai Motor Company, which shipped 1.1 million vehicles to American driveways in 2024, saw its stock nosedive. We saw a 6.1% drop in intraday trading. That is billions of dollars in market cap evaporated in minutes. Why? Because the US market is the golden goose for Korean exporters. If you make a Hyundai Santa Fe in Ulsan and have to pay a 25% tax to get it into the port of Los Angeles, you have two choices: you eat the cost and destroy your earnings, or you pass the cost to the American consumer and lose market share to Ford or Toyota. Both options are terrible. But this isn't just about cars. It includes all other reciprocal tariffs. Trump is essentially saying, if you don't honor your contract, we are ripping up the trade deal. Now, looking at the charts from Tuesday morning in Seoul, we saw the panic. The Korean won weakened by 0.7%. Bond futures ticked higher. The Kospi, Korea's version of the S&P 500, fell 1.2% before bargain hunters stepped in to buy the dip. But here is the million-dollar question: is this real? Or is this just the art of the deal playing out in real time? We have to look at the track record. Data from Bloomberg shows that since late 2024, Trump has issued dozens of these threats. But only about 27% of them were fully executed. And of those, the share that actually remained in place long-term is closer to 20%. So, statistically, there is a 70% to 80% chance this is a bluff, a negotiation tactic to light a fire under the South Korean parliament. But as an investor, are you willing to bet your net worth on those odds? Because if this lands in the 20% that do happen, we are looking at a supply shock that could reignite US inflation. To understand the trade, you have to understand the politics. Why hasn't South Korea just written the check? They are a rich country. They are a close ally. What is the hold-up? It turns out, the bottleneck isn't the president of South Korea, it's their parliament. Last year, after the handshake deal with Trump, a bill was introduced in Seoul. It was called the Special Law on Strategic Investment with the U.S. This law was supposed to be the green light. It would give the Korean government the legal authority to force massive corporations to pour billions into the U.S., and in exchange, the U.S. retroactively cut auto tariffs from 25% down to 15%. The U.S. kept its side of the bargain. The tariffs came down. But the Korean bill? It's gathering dust. It was introduced in late November, but it hasn't been fast-tracked. The opposition party in Korea, the People Power Party, is playing hardball. They are demanding that the tariff deal be fully ratified before they pass the special law. It's a classic chicken and egg political standoff. But there is a deeper economic fear in Seoul, and this is something Western media often misses. Bloomberg Economics hit the nail on the head. They pointed out that the South Korean government has been playing it slow. Why? Because the investment pledge is roughly $350 billion. Think about that number. $350 billion leaving the South Korean economy to build factories in Ohio, Texas, and Georgia. That is a massive capital outflow. When that much money leaves a country, it puts immense pressure on the local currency. The Korean won is already fragile. If they rush this investment, the won could collapse against the dollar, making energy and food imports wildly expensive for regular Koreans. So, the finance minister, Koo Yoon-cheol, is in a bind. He came out and said, "We aren't intentionally delaying. We are just selecting projects. It takes time to find sites and finalize designs." That sounds reasonable, right? To Donald Trump, that sounds like an excuse. Trump operates on a transactional timeline. I gave you the tariff cut, you give me the factories. Now. The delay has created a vacuum, and Trump is filling that vacuum with volatility. The South Korean Blue House was caught off guard. They hadn't even received a formal notification before the Truth Social post went live. Now, they are scrambling. Industry Minister Kim Young-kwon is booking the next flight to Washington to beg for mercy from Commerce Secretary Howard Lutnick. But the clock is ticking. The Bloomberg report suggests that because the threat of tariffs is now the proximate danger, Seoul will likely capitulate. They will force the bill through in February because a currency crisis caused by capital outflows is bad, but a trade war with the United States is catastrophic. If you've been subscribed to this channel for a while, you know we look for patterns. 1 data point is an anomaly, 3 data points is a trend. This situation with Korea is not an isolated incident. It is part of a calculated, aggressive strategy that defines Trump's second term. Let's look at the board. Target 1, Canada. Just weeks ago, Trump threatened to raise duties on Canadian products to 100%. Why? Because Ottawa was flirting with a trade deal with China. Trump's message was clear: you are either with us, or you are against us. There is no middle ground. Target 2, Europe. This one sounds like fiction, but it's real. Trump has threatened new charges on European goods because of his renewed quest to seize control of Greenland. It sounds absurd, but the economic leverage is real. Target 3, Iran and the Middle East. He's threatening tariffs on anyone doing business with Iran to pressure Tehran over anti-government protests. And now, Target 4, South Korea. Even though Korea is a model ally that spends 3.5% of its GDP on defense, which is huge, by the way, much higher than most NATO countries, it doesn't matter. The lesson here for investors is that political alliances do not equal economic safety. In the Trump 2.0 era, trade relations are transactional and renewable on a daily basis. Peter Kim, a managing director at KB Securities in Seoul, put it perfectly: agreements often remain subject to change. This creates a risk premium on everything. If you are holding stocks in companies with complex international supply chains, Apple, Tesla, Nike, Hyundai, Samsung, you are exposed to this risk premium. The market hates uncertainty. And right now, the White House is a factory of uncertainty. However, we have to look at the boy who cried wolf aspect. As we mentioned, most of these threats get scaled back. Remember 2018? The fire and fury rhetoric eventually calmed down into manageable trade deals. Remember the threat to shut down the Mexican border? It turned into the USMCA. The pattern suggests that Trump creates a crisis to gain leverage, forces the other side to panic, extracts a concession, and then declares victory while the market recovers. The smart money knows this. That's why Young and Yoon from Fibonacci Asset Management said, any pullback will likely be a sentiment-driven dip, not a structural issue. Translation: buy the fear. When Hyundai drops 6% on a tweet, the algorithms sell. But the fundamentals of Hyundai haven't changed. They still make cars people want. If you believe the tariff threat is a negotiation tactic, that 6% drop is a gift. Okay, let's bring this home to the US. Why should a guy living in Chicago or a family in Manchester care about the Korean National Assembly's legislative schedule? 1. The auto market and inflation. The average price of a new car in the US is already astronomical. Hyundai and Kia have been the heroes of the middle class, offering affordable, high-tech SUVs. They have massive market share. If a 25% tariff hits, one of two things happens: A. Hyundai eats the cost. Their profits collapse, they cut US marketing, they cut US jobs at their dealerships. B. They raise prices. That $30,000 SUV is now $35,000 or $37,000. This is inflationary. If foreign cars get more expensive, domestic manufacturers don't keep their prices low out of the kindness of their hearts. They raised their prices too, because the price floor of the market just went up. If inflation ticks back up because of tariffs, the Federal Reserve cannot cut interest rates. They might even have to hike them. That means your mortgage rate stays high. That means your credit card APR stays high. 2. The digital war and tech stocks. There is a subplot here that is barely getting coverage. The US is angry about South Korea's digital regulations. Washington claims Seoul is unfairly scrutinizing US tech firms. There was a massive data breach at Kuwang Incorporated, and the fallout has led to strict regulations that hurt US companies trying to operate there. If this trade war escalates, South Korea could retaliate by making life miserable for US tech giants. We're talking about Google, Meta, and Netflix, all of whom have massive user bases in Korea. If Seoul decides to slap a digital tax or block market access in retaliation, those stocks in your 401k take a hit. 3. The US dollar. When trade wars heat up, capital flees to safety. Usually, that means the US dollar gets stronger. Wait, you say, isn't a strong dollar good? Not always. A super strong dollar kills US exports. It makes American goods too expensive for the rest of the world to buy. It hurts the earnings of multinational companies like Coca-Cola and Microsoft, who earn money abroad. When they convert those weak won or euros back into strong dollars, their earnings report looks terrible. If the dollar spikes because of this chaos, expect the next earnings season for the S&P 500 to be disappointing. So, where do we go from here? As we look toward the February legislative window in Seoul, I see 3 distinct scenarios. Scenario A, the art of the deal, capitulation. This is the most likely outcome. The South Korean parliament realizes they have no leverage. The opposition party caves. They pass the special law on strategic investment in February. Minister Kim travels to Washington, shakes hands with Howard Lutnick, and announces a fast-tracked investment schedule. Result, Trump claims victory. The tariff threat is withdrawn. Hyundai stock rallies 10 to 15%. The won stabilizes. This is the buy the dip scenario. Scenario B, the gridlock and punishment. South Korean politics are messy. The opposition party might refuse to budge just to spite the current president, Lee Jae-myung. The February deadline passes with no bill. Trump follows through. He signs the executive order. 25% tariffs go live in March. Result, Hyundai and Kia prices spike in the US. Inflation data ticks up. The Fed sounds hawkish. The Korean won crashes, forcing their central bank to intervene. Global markets take a 5 to 10% correction as traders price in a prolonged trade war. Scenario C, the escalation. Trump decides 25% isn't enough. He links the trade issue to the defense issue. He threatens to pull troops out of the Korean peninsula unless they pay more and fix the trade deficit. Result, geopolitical crisis. North Korea gets emboldened. Defense stocks surge, but the broader market crashes due to fear of war. This is the black swan event. The data is clear, we are entering a period of maximum volatility. The era of set it and forget it investing is paused while the world adjusts to this new, aggressive American trade policy. So, what do? 1. Watch the Korean won. This is your canary in the coal mine. If you see the won crashing further, it means the insiders in Seoul believe the deal is dead. If the won starts strengthening, the deal is happening. 2. Be careful with autos. I would be very cautious with auto stocks right now. Not just Hyundai, but all of them. The supply chain chaos of a tariff war hurts everyone. 3. Look at domestic manufacturing. If Trump is going to force production back to the US, companies that specialize in building factories are the winners of the America First investment mandate. The threat against South Korea is a wake-up call. It proves that in 2026, there are no sacred alliances when it comes to the US trade deficit. Seoul has until February to fix the paperwork. If they don't, we are going to see exactly how much pain the US consumer is willing to tolerate in the name of fair trade. Keep your eyes on the news, and more importantly, keep your eyes on your portfolio. I'm Boss, and this is Boss Economics World. If you found this breakdown valuable, smash the like button, it helps the algorithm more than a trade deal helps the deficit. Subscribe so you don't miss the update when the decision finally drops. Thanks for watching, and I'll see you in the next one.